Short selling in the stock market is a trading strategy that allows investors to profit from the decline in the price of a stock or security. In a short sale, an investor borrows shares of a stock from a broker or another investor and sells those shares on the open market. The investor aims to buy back the shares at a later time, ideally at a lower price, to return them to the lender. Here's a step-by-step breakdown of how short selling works. Borrowing the shares. The investor contacts their broker or brokerage firm to borrow shares of a specific stock that they believe will decrease in price. The broker locates the shares from their inventory or borrows them from another investor who holds the shares. Selling the borrowed shares. Once the investor has obtained the borrowed shares, they immediately sell them on the open market at the prevailing market price. The proceeds from the sale are credited to the investor's account. Waiting for the price decline. The investor anticipates that the price of the stock will fall in the future. They aim to buy back the shares at a lower price to return them to the lender and profit from the difference between the selling price and the buying price. Buying back the shares. When the investor decides to close their short position, they buy back the same number of shares they initially borrowed from the market. The goal is to purchase the shares at a lower price than the selling price, generating a profit. Returning the borrowed shares. After purchasing the shares, the investor returns them to the lender, typically their broker, to close the short position. The borrowed shares are returned, and any fees or interest associated with the borrowing are settled. It's important to note that short selling carries significant risks. Since there's no limit to how much a stock's price can rise, losses in a short sale can be unlimited. If the stock price increases after the short sale, the investor may need to buy back the shares at a higher price than the selling price, resulting in a loss. Short selling also involves borrowing costs, such as interest or fees, and may require maintaining a margin account with sufficient collateral. It's crucial to understand the rules and regulations surrounding short selling in your jurisdiction and consult with a qualified financial professional before engaging in short selling activities.